Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for December 2018. Let's take a look at key highlights of November. The Indian GDP grew at its slowest pace in 3 quarters at 7.1% for the quarter ended September. The growth was expected to be between 7.4% to 7.6% according to consensus views. Eurozone PMI fell to a 25-month low of 52.7 in October from 54.1 in September, owing to falling exports as trade war concerns loom. Emerging markets have piled on more debt since Great Financial Crisis of 2008. From the depth of crisis, the debt as a percent of GDP has nearly doubled. Brent crude prices went below $60 per barrel for the first time this year amidst part easing of sanctions on Iran, rising US crude production and expectations of slowing global demand. This would hit commodity-producing emerging markets like Russia, Brazil and GCC countries as well. India's trade deficit has widened to $112 billion in H1 financial year 19. India's exports have failed to grow sharply, registering a 13% growth in financial year 19 so far. Indian rupee has appreciated by nearly 5% over the last 1 month, eating away some positive for exports growth. The last few months have been turbulent and volatile due to global macro shenanigans, a credit scare and elections. In addition, with general elections around the corner, while volatility may persist, opportunities are starting to emerge. We see 2019 as 2 halves, defensive in portfolio but opportunistic in approach in the first half, and in the second half post-elections, riding what should be the time has finally come, measured but an extended upcycle. The Nifty has increased by approximately 5% in the month ended November 30th. This is mainly due to a steep fall in crude oil combined with rupee appreciating to approximately 70 per US dollar after a low of 74 per US dollar. On the earnings front, Bloomberg's Nifty Financial Year 19 EPS estimate continued its downgrade and reached 582. Also, Nifty trailing 12 months diluted EPS from continued operations increased to 463 in September end, while the growth declined to 6% year-on-year. Nifty PAT is expected to grow by 10.1% in Q2 financial year 19, while top line is expected to grow by 14% on an equal weighted basis. Delayed festive season this year along with the Kerala flood are likely to play a drag on volume growth, while a depreciating rupee and rising interest rates shall put pressure on earnings. However, better realizations-led growth is likely to drive earnings in the energy as well as basic materials sectors, which would be the major drivers of earnings growth this quarter. Nifty blended forward 12 months consensus PE stands at 15.8 times currently, assuming an EPS growth of 30%, which is overstated in our opinion, and thus we maintain that the index remains overvalued currently. For investors who are underinvested in equities, we would recommend completing 50% of the planned allocation over the next 3 months. Allocations should be focused on multi-cap investment strategies and select opportunistic plays. For those who are fully invested, hedging options can be explored. Government of India 10-year yields have declined nearly 65 basis points from peak of 8.25% to 7.61% at present. RBI's softening of hawkish stance, INR 1.27 trillion of OMOs and a fall in oil prices have put a lid on rising yields. Foreign flows into the secondary debt markets turned positive in November. Since India offers a very high level of real interest rate with stable inflation picture, a stable currency would at least stem outflows seen in H1 financial year 19. Inflation has remained below the RBI's target of 4% for financial year 19 so far. Disinflationary trend in food article inflation and elevated core inflation paints a bipolar picture of prices pressure in India. RBI conducted the open market operations purchase of government securities for an aggregate amount of 40,000 crores in November taking the total OMO purchases to 1,27,000 crores in the year. It further announced 40,000 crores OMO purchase in December to ease liquidity pressure. Currently, the yield curve has flattened out as compared to 3 months ago and 6 months ago due to rapid rise in short-term rates on account of RBI rate hikes and stress in CP market. We expect yields to remain sticky from 7.5% to 8% for next few months. Government's fiscal management will be key as tax revenue growth remains below our expectations and budget estimates. We recommend investors to allocate 100% of their fresh fixed income allocation to low duration offerings such as overnight and liquid funds, arbitrage funds, high quality roll down and buy and hold strategies. In addition, structured products, high quality bonds and long-term yield generating strategies can also be considered.